Welcome back to the Consumer Credit Matters podcast. I'm your host, William Black. In this episode, we cover the auto retailer Carvana, which has spent the last 2 years staging a bit of a comeback, and now it's doing something that has the franchise dealer world genuinely uneasy. It's pushing into the new car business, and is doing so on two fronts. It started buying new car dealerships and selling new vehicles, and has taken a stake in Slate, the low-cost EV startup backed by Jeff Bezos that wants to be one of the first new American car brands in years and says it will have new vehicles on the road by year-end. So what I wanted to dig into is whether this is a real push into the new car channel or a cheap experiment with a lot of option value, and what it means for the OEMs, the franchise dealer model. And to work through this, I have got the right guy back in the studio, Charlie O'Shea. He's covered these names for years at Moody's, and he's followed the company since the beginning. Please join us. Charlie O'Shea, welcome to the Consumer Credit Matters podcast. Welcome back.
Thank you. Thank you.
Great
it's
to
nice
have you.
to be back.
We've had a couple of conversations about Carvana, but they're back in the headlines more recently on two fronts, as I see it. One is they've acquired now a handful, I think it's still single digit, in fact, dealerships, right, throughout the country. And they are selling new cars, getting into the new car space where they have almost exclusively been a used car shop. They are now selling new cars through these dealerships. And by evidence of this report from the Journal, they are knocking it out of the park by orders of magnitude. We'll talk about that a little bit. The second thing that I saw that I wanted to talk to you about and get your opinion on is Carvana's entry. I don't know if partnership is probably not the wrong word with Jeff Bezos's new EV manufacturer called Slate, which is expected to deliver low-cost, affordable electric vehicles made here in the U.S. to U.S. customers by the end of this year. So Carvana is going to have an outsized role, at least out of the gate, in selling those vehicles across the country. And so, again, kind of a two-pronged effort to sell new vehicles coming here all at once in 2026. This is a big change, and it's certainly ruffling the feathers of many, at least dealerships, in certain regions of the country, and has even, I think, garnered the attention of Stellantis, who's tried to put a little bit of the brakes on some of the dealer acquisition moves that Carvana has made. So with that kind of as the setup and background, Charlie, maybe you can fill in some of the gaps in that context as you see it.
Yeah, I mean, it's always nice to be right, and I think we were. I was, taking a walk down memory lane over the weekend while we were prepping for this, and I looked at the first press release I wrote when I did the initial ratings on these guys way back when I was at Moody's in 2018. And we talked about how inefficient the used car business is, how the franchise dealers were late to the party because they never really had used businesses until after the financial crisis. They wholesaled everything. And the potential, the risk there of obtaining new cars, or obtaining used cars. They were going to be, doing more auction work, which would drive costs up in the beginning. And when ADESA came, I was already gone by then, but I thought ADESA was a moonshot. We talked about this on one of our old podcasts, but I thought ADESA was a moonshot, and I saw no risk at all with ADESA, and that wasn't shared by a lot of people. Because it gave them access to vehicles, which is, the proof is starting to play itself out here. And, quoting a famous writer, rumors of my death have been widely exaggerated. They were close, but not that close. The fundamental business has never been bad. I mean, there was always going to be growth. There was always going to be excess capacity. They were always going to have to grow into their infrastructure because the smartest way to do things is to have excess capacity. This is a classic retail model. The advertising spend is leveled out as, volume grows. You start looking at things on a per unit basis, and both from profit and from expenses, and everything, the curves crossed. These guys are selling 600,000 cars in a year. they've doubled what they did 2 years ago from a volume and revenue perspective, which is absolutely amazing. Let's talk about the fundamentals here for a second, industry fundamentals. They've got billions of excess capacity to offload, um, the consumer credit part of the business. So the volume isn't going to be a problem. They're picking up cars from consumers. The debt level is manageable given the scale. I always felt when I first started looking at this as things kind of percolated that if they got to 500,000 cars, that was going to be a really big deal. And they would break even at somewhere between 350 and 400, given the cost base back then. The fact that they're at six now, and then this is like, runway to the moon here for them. And the demand is there. We talked about this before.
Yep.
There's 40 million used cars a year. They've got my math skills are awful, but they've got a de minimis percentage of the sales. They're now in a bunch more markets. ADESA gave them all this reconditioning capacity. They've got access to more vehicles because of ADESA through the auctions. I mean, this company is really well positioned right now, and the near quote unquote near death experience. Well, we're in COVID, so things are soft.
Yeah.
You make a game changing acquisition, and I would argue if they hadn't done it, that would have been negligent. Sometimes you just got to hang it out there. And
You're talking about ADESA, and this was their purchase of basically a wholesale channel into their what had been essentially a retail chain,
right?
You could call it. So getting large volume of cars at wholesale cost was in hindsight, an ill-timed acquisition because it was just prior to, or maybe it was just coincident with the COVID era,
right?
And it was a big. It was a costly acquisition.
Absolutely.
Unfortunately, the wrong time. So that put a lot of pressure on their liquidity position at the time.
Right.
And so that's what you're referring to, just for listeners' sake, as the near-death experience, right?
Yeah. And the crazy part is you had a lot of pundits out there, and I use that term very pejoratively. You had a lot of pundits out there saying, oh my God, they can't do this. What are they doing? Et cetera, et cetera, et cetera, including some investors and some rating agencies, and they didn't get it. They didn't get what this would give them, and they're reaping the benefits of this. It reminds me years ago Walmart was going to make investments in the world when crazy stock drops 10% in a day, and those investments pay off. Savvy management teams with vision that really understand their business don't make mistakes when it comes to acquisitions, and this was hardly a mistake. This was visionary. And this was a generational transformation of this business, as well as I could argue, and I'll get hyperbolic here for a minute, as well as for the industry itself. Because if you look at what has happened with Carvana since then, vehicle acquisition costs are way down. Yep. They get the benefit of the revenue from the auction business on top of access to vehicles that they can put into their network.
Much bigger funnel. Right?
Exactly. And, personal examples, and, you know this, I have sold 3 cars to Carvana, and I have to tell you, it's been the most seamless, painless exercise. The one I did was within the last month. I put the thing on the website on a Saturday morning, and they picked the car up and gave me a check Saturday afternoon. It's absolutely amazing.
This is hitting the market at an inflection point. It's been going on for a while now, but they were able to really take advantage of the way customers want to do business. And we've heard this before, even in decades past. I remember Saturn dealerships were kind of set up as the no haggle, kind of no muss, no fuss dealerships. And others have tried it, but Carvana, ordering a car, literally buying a car, I should say, from your cell phone or your desktop is something, and they're not the only ones who do it by far. Lots have joined that. It's a very competitive field, but they're among the best and most successful in using that platform. But again, not to get away from the headlines here, they've been doing that successfully for some time. And as you pointed out, the used car market is enormous. The new car market, it is a lucrative part of the market, even though it is much smaller in size. And Carvana's move into that market is possibly transformational for them. It's certainly gotten the attention of dealerships in the regions in which they've now owned dealerships? Because I remember one anecdote from one of the journal article that I referenced was they bought I think it was a Dallas dealership. They had, I think, close to 10 times the per month sales volume after they took it over. Now, we can't get into all
That's tough.
the
Yeah.
details of how they were able to do that, how much of that was cannibalizing their own business that they would have done anyway. Don't know all the details of that, but it's gotten the attention of dealerships who are saying, hey, this is unfair. What are you doing allowing this kind of dealership expansion? Stellantis, as I mentioned earlier, put the brakes on. They actually said they throttled Carvana's ability to buy Stellantis dealerships in any case to, I think, one every year or something like that, one every rolling 12 months, some kind of rule that basically slows down their potential acquisitions of those types of dealerships. But, look, if you can't compete, you're going to go out of business in those regions where Carvana is. So it definitely ramps up the level of competition in those regions, and like I said, has gotten the attention of many dealerships in the region.
Yeah, the new car, it's a toe in the water. And
Yeah.
I a few things. One, the new dealers, revenues are driven by new car sales. You make all your money servicing, and you make a lot of money selling used. With the new model, if you're not wholesaling, you can make a decent amount of money with used, and then you get the financing, you get the service going for it. So it becomes a flywheel.
Right.
And in Carvana's case, one of the risks I saw early was the lack of service capability. They're working on that. The reconditioning centers will be hubs for service at some point. At some point, I also think that they should do more with some of the national players on joint venture bases, that sort of thing, because that was a hole in the model. The new business gives you, it's a laboratory experiment, really. You're gonna it's kind of like when Amazon opened the small format store. All right, we're going to throw a few at the wall, see what happens. If it doesn't work, no big deal. The same thing happens here. And the Stellantis phenomenon is the way the business works. The OEMs have to sign off on any new franchise owner. So, Carvana is at the beck and call, if you will, of the OEMs. If the OEMs don't want them to have a dealership, they're not going to get it. And the OEMs are wedded to their existing dealer bases. They don't want to ruffle any feathers. They've been down that road before. Ford tried to do, company-owned stores, 30 years ago. It didn't work. You hear all this direct-to-consumer stuff with some of the OEMs. That's a slippery slope. You've got, 18,000, 19,000 dealers in the U.S. that are wedded to the OEMs. That's a big pile. And there's a lot of people you got to keep happy.
How do the OEMs keep the dealerships happy? The OEMs need to sell cars at the end of the day. Yes, they need to keep their dealership network happy, but they need to sell vehicles. And if their dealerships aren't able to keep up with the next, game in town, we're using Carvana here as an example, but there are other Carvanas out there that are just, that have the national presence and network and capital levels to replicate or at least get in the game that Carvana has already kind of got a toehold in, as you say. How do the OEMs circle that square? How do they keep their dealership network happy? I mean, we saw the Stellantis example of slowing down the acquisition. How long does that last? How much sympathy do you have for the dealership that just can't compete with, a Carvana-owned dealership next door that's doing 10x their business and is basically running them out of town?
Well, it's, I've used this example in the past. Whenever a BMW dealership anywhere in the world runs into a problem, Roger Penske gets a phone call. And that's what happens. The dealer, the OEM will say, gee, we've got a dealership here that's not performing very well. We have some levers to throw. We can tell them you need to refresh the store. You got to put in a renovation project. And if they don't have the money, don't lend it to them. and then they're kind of forced to sell. Um, you know, urge them to sell. And that's how a lot of this stuff happens. Generational changes with dealerships. It's a family run business for the most part, at the local level. Somebody doesn't want to work that hard to make money. They'll go to the OEM, or they'll talk to one of the dedicated investment bankers that does this. There are a couple of them out there, and they'll broker a sale, but the OEM has to bless it, and that's critical. But the OEM has ultimate power over that franchise. They
Yeah.
can, they can pull it. They can make it very expensive for you to maintain it. Um,
If
and
you're
that's
not pulling your weight, basically, you're saying
exactly,
like
yes,
let competition occur, and may
right.
the best franchise owner or the best dealership owner win. And
It's exactly right.
so the OEMs, they may want to have a call it managed competition, so it's not a bloodbath, and that
Right.
maybe customers don't get frustrated. It probably is they're foremost in their minds. But at the end of the day, they need to push metal out the door,
Yeah.
and whether it's a
You know,
Carvana owned dealership or a locally owned dealership, they're less preferential,
yeah.
or
And
they're
this is,
not preferential.
to be really crass about this, there's a certain Lord of the Flies feature to the auto retail business where,
Hmm.
the big guys, for years, the manufacturers didn't want these super dealer chains. And then they realized that it actually does benefit them. Customer satisfaction goes up, service goes up, warranty work gets done better, et cetera, et cetera, et cetera. Um, but the US is still over dealered. Before the financial crisis, and I'm pulling up historical stuff here, but I think it's relevant. There were like 22,000 dealers in the US. And you would have thought with, Chrysler and GM's bankruptcies and all that stuff, that there would have been a culling of dealerships. Well, it really didn't happen. So
Hmm.
now we're still in the high teens. If you look at volume, and Toyota's the highest volume, per dealership OEM out there. If you look at their model, we're still probably 3 or 4,000 dealers too many in the US. So there can be a natural, Darwinism that can happen here. And it's been happening. Whenever a new, whenever a Lithia or Penske or any of the big guys buys a network, they're usually closing some stores down. There's some inefficiencies, there's some
Sure.
overlap, and that happens. And that's just the natural cycle of things. It's similar to retailers closing stores. I saw something this morning that Family Dollar is closing 1,000 stores. Well, I was in a plaza yesterday, and there's a Family Dollar right next to a Dollar Tree. Yes, they have to do that. They've got to kind of, you know, thin the herd, so to speak. And in auto retail, it happens, but not as often. It's hard to close a dealer. One of
Mm.
the anecdotes I used to use during the financial crisis, and when GM and Chrysler were going south, was it seems like every auto retailer in the world, in the US, has a congressman on speed dial.
Mm.
They're embedded in the community. They're big in Rotary. They're big in Kiwanis. They sponsor sports teams, all that kind of stuff. And the political pressure to keep these open was pretty acute back then. And I think that's a reason that we didn't see more thinning of the herd, so to speak. Um, but, circling back to Carvana, this is riskless. You know, they've got a ton of capacity within the existing network to do almost anything they want to do. You know, make a small bet, see what happens. You'll learn things from running new dealerships that you don't know from not running. Again, it's a similar Amazon phenomenon. When Amazon
Hmm.
was purely online, they had no idea how to run stores. They didn't know any of that. They open some stores, they buy Whole Foods, they learn a lot.
Well,
And there's
that's exactly how Ernie Garcia III, the CEO of Carvana, is characterizing this
yes.
entree into the
Yeah.
dealership world. Is I don't want to misquote him here, but I think it's an experiment still. It's still at the
Absolutely.
experimental stage. Like I said, it's
Yep.
only a handful. I think it's still
Right.
literally in the single digits. So,
Yeah.
but just to, I mean, why we're talking about it today is because it's getting the attention
Yeah.
of the entire dealership
Oh, I
network,
know.
because
I
it
know.
is
And
a
it's,
threat.
yeah,
And it will
the
be,
boogie,
if they're
you know,
successful, it will definitely be imitated by others. I'm thinking CarMax could easily get
yeah.
into the same game if they
Car-
wanted to, right?
CarMax did this.
Oh,
They did this, 15 years ago or so, and they didn't like it.
mm,
Um, but they all already operate brick and mortar dealerships, which Carvana does not do. So you know, you're basically betting lunch money on this, so to speak. There's nothing, you're not betting the ranch, and you learn, you don't. I would think it's an opportunity, not a risk. And if it works, like you said, they can buy more, but with the caveat that the big dealerships aren't going to want these guys in the game. There's no way that Alithia, Penske, AutoNation, any of them are going to be very happy to see Carvana getting on their turf on the new car sales front. So they're going to go to the OEMs and say, "Hey, you really shouldn't do this. We'll buy more if that's a problem. Us, we're established, blah blah blah." So I don't know that it could scale under the present environment with OEMs and with the rampant consolidation we've seen in the industry over the last 10 or 15 years through acquisition and combinations. But it's kind of neat. It's neat to see.
That's a really good point, kind of the limitations and what would be the pushback and how that pushback would manifest. That's a very good point. That brings me to topic number 2, which is also certainly you call it lunch money, but a small bet, but with potentially big upside. And again, right in this lane of how do we sell new vehicles and expand our funnel from, almost exclusively used to now new. And that is this news about Slate. Now, Slate, just a little bit of exposition here. This is Jeff Bezos backed, project to build and sell affordable cars, EVs, in the U.S. Made in the U.S. for Americans. Maybe he has aspirations to deliver them outside of the country. I'm not sure. But this is coming to a theater near you because I think they're expected to deliver vehicles by the end of this year, if I'm not mistaken. And the big announcement with respect to Carvana is that Carvana will be the sales channel, at least initially, for these new vehicles when they start to come online. And so, again, I think they've taken bought some warrants in Slate at this point. And Slate is still in a Series C round of financing. So it's still early inning. It's not even the first inning really, but it's, pre-inning game chatter at this point. But again, love to get your thoughts on this bet, as it were, for Carvana.
It's another throw something at the wall.
Yep.
What's the classic thing? 10% of your money you can, kind of put anywhere. It's, US BYD in my mind. And BYD has been incredibly successful in China. I mean, that's the model everybody's looking at to see, cheap electric vehicles. I'm still kind of in the, what's the demand for EVs here now that the government isn't jamming them down everybody's throat.
Right, you're talking the sunset of the tax. I think it was $6,500. It was a very substantial $7,500 tax credit that sunset last year.
And the cafe regulations are now out the window. All this kind of stuff that I grew up in Detroit. I have an affinity for internal combustion. But the BYD deal makes a lot of sense. I reserved
Mm-hmm.
my truck just, a little while ago, $50 on the website. So
wait, this is with whom?
With Slate.
Oh, you did? Okay, I didn't realize that. So they're open for you can actually get online.
$50.
Okay,
yeah, it's refundable. And I did it just again, it's a laboratory experiment. See how the process works.
Good for you.
I have one of my son's friends took 2 years to get a Rivian off the wait list, and my neighbor's had a couple, and he's had to buy them pre-owned. So let's see how this plays out.
But those are. I'm just again to solidify people. Those are premium,
those are
vehicles,
expensive.
very expensive.
Yes. Yep.
The whole niche here that I think Slate is trying to address is how do we produce? You said it actually very succinctly. Is a BYD like? If you're not familiar with BYD, these are cars that are selling for somewhere in the neighborhood of $20,000, or would sell somewhere in the neighborhood of $20,000. Except that the U.S. slaps, I think, a 200% tariff on those vehicles. So you don't see too many of those rolling around the U.S. No. But if you didn't have to pay that tariff, and you wouldn't if you're building them in the U.S., then there are virtually, I don't know if there are any cars that are 20,000 now. They stopped making
There is no new vehicle in the United States you can buy for $20,000. And I don't know. I know very little about the specs and stuff. For $50, I didn't care. But the range, charging stations are everywhere now, so that's not an issue. Range is the big thing, especially in a colder climate where battery life goes through the basement in the winter for a lot of these EVs.
Yeah,
The range gets cut in half in some cases. So let's see what happens. But Bezos is a smart guy. I mean, I've been around Amazon since 1998 in some fashion, either as an investment bank or an analyst or a lender. They haven't made a lot of mistakes. Bezos hasn't made many mistakes over the years.
right.
Built what I would argue to be a very successful business from nothing, and going from books to AI.
And he's willing
You
to
know,
play the long game for sure.
yeah,
He's
absolutely.
proven that with
Yeah.
Amazon.
If you go back and read his first shareholder letter, it's it still plays today. They put it in every annual report since then, and it is the long game.
Yeah.
He categorically says we have an opportunity here, to do this because of these factors, time frame and stuff. And he can play the same thing with autos, where the Chinese have proven that you can develop a small, an inexpensive vehicle that will be popular with consumers,
Hmm.
especially in urban areas. And we're going to bring it over here. We're going to bring that idea, that concept to the US. We're going to build them here so we don't have to worry about tariffs. They've got a plant in Warsaw, Indiana. It's an old printing plant that opened in 1958, I think. They're going to retrofit it. They're going to hire people, and let's see what happens.
Yeah.
It's going to be neat it'll be neat to see. I've seen a lot of these, niche cars over the years, as you well know, Bricklin,
Hmm.
DeLorean, Smart, a whole bunch of places, and nobody had the resources that Jeff Bezos has to
Right.
throw at this, and the patience. And it'll be private until it's not. So he'll
A-
control it, and he's not going to have to worry about anybody.
And it's hitting the market exactly. It seems like it's hitting the market with the right concept at exactly the right time. There's no more popular word right now than affordability in the
No, no.
the financial zeitgeist. So, again, what we're talking about here is Carvana moving into the new car space and through these two channels with very little down in
Yes.
the bet, as you put it, but huge upside potential for
Mhm,
Carvana. It certainly ramps up competition, which should benefit consumers.
mhm,
For the in terms of the price of new cars. So that's a benefit, at least in this run up uh, of their move into the dealership in the new car space
mhm.
in the months to come, especially as this Slate ambition starts to hit the road. Well, this is a story that we will definitely be coming back to you for, Charlie.
Okay.
It's going to get only more interesting as the year progresses, and probably years plural progress, because Carvana has just been on a hot streak, like we said. They're moving in
Yep.
new areas. They're ruffling some feathers. Adds for a little bit of drama to the narrative for sure. And I think they're proving the naysayers wrong at this point. I think we can say that with some data
Yeah.
now behind us
Yeah.
to support that.
Disruption means disruption, and a lot of the incumbents don't like disruptors. I mean, I've been seeing that for a long time with Amazon.
Right.
But it's better for the consumer, obviously. More choices.
Thanks for coming on again, Charlie. Really
Okay.
appreciate
Great
it.
seeing you, Will.
Thanks. Thanks,
Take
listeners.
care.
We'll be back soon. Bye.